How are you, folks? The Entity Cosenza podcast. This is what part is it now? This is part 4 of the Federal Open Market Committee lectures, and for the final exam and for the last project for the graduate course. So let's get right to it. Okay, we had a very exciting week, certainly. Signature Bank, we'll talk about that this time. I think we talked about Silicon Valley Bank the last lecture. These are some other banks. So in March 2023, what's the concern? The big concern out there is recessions and bank failures and what the returns in the equity markets are going to be, and how the treasury market's going to operate, and all certainly real estate, labor. Those are all the concerns that are happening out there right now. So we'll briefly look at what a holding company is, and we'll go over some just basic financials of a couple of these banks. It's a similar conversation for all 6 of these. Certainly, Silicon Valley and Signature are in there, so that's where that is. Excuse me. So Signature Bank is shut down by regulators after Silicon Valley Bank collapsed in California recently. So it was one of the crypto market's leading banks. A couple summers ago, we were seriously contemplating getting involved in crypto, and I think looking back, maybe now it's good that it hasn't, because anytime the basic operation of a bank, and hopefully what you guys are learning this last month with all the conversations and the activities that are happening with banking, is that you have to have assets that back up deposits. Now, if those assets are cash flow generating loans, if it's the bank trading for its own account, it's all of those kinds of things that support your depositors. And your depositors, as I said in class, are just another version of a stakeholder or an equity holder. As far as the accounting equation is concerned, a depositor, an owner putting up capital, or the owners of the bank taking out a loan, all 3 of those basically act to capitalize the bank. And the bank's either got to generate return with that cash in terms of assets, in terms of financial instruments, debt instruments, equity instruments, ownership, whatever it might be, real estate. They've got to generate some kind of asset. And with the Signature Bank situation, the idea to generate returns and certainly grow your assets was the cryptocurrency area, and digital assets, which certainly took a big hit after the FTX. The exchange, which, by the way, if you look for what's his name? Is it Victor David? This one of the Seinfeld guys. He made a great commercial. Not the last Super Bowl, but the one before that. The one in January 2022 for the or February 2022 for the 2021 season. David something, or Victor David, but he was one of the writers. He never has to work again because he's getting residuals from Seinfeld that'll last him and his family members, a long time. So, but it's where he's the Egyptian, and Thomas Edison is pitching a light bulb, and he goes, you're wasting your time. You're wasting about the light bulb, and then Benjamin Franklin, where they're drafting the Constitution down in Philadelphia, and they say stupid people can vote, and they all want to ratify the Constitution. And it's like a little movie. It's like a 2-minute movie, but it's really good. And then I think he's in the Middle East someplace drinking coffee, and he goes, "That's terrible." So in other words, the idea was all of his decisions were the wrong thing. It's like he said coffee was terrible. He looks at Edison and goes, "You're wasting your time, right? You're with the here. Can we find that? Let's see if we can." It's hysterical. It's really funny. It's really funny. I think it's FTX commercial. Larry David. That was the guy. Oh, it's so funny. This was so funny. Here it is. He goes, "You're wasting your time. All right, you're wasting your time." So I don't know. It's the 2-minute one out of this 3-minute one. I don't know why this one's 3 minutes, but all it is just simply 2 minutes. There. The wheel. I call it the wheel. The wheel. I don't think so.
What does it do?
What does it do?
The rules. Yeah, so does a bagel, okay? A bagel you can eat. One of the worst ideas I've ever heard.
That's the wheel.
Behold, it's a fork. I got 10 forks right here, baby.
That's the monks, the Franciscans in Europe.
My lord? What is it? A toilet, my lord. A toilet? You expect this court to do its business inside?
This is funny.
Like animals?
This is funny.
Outside like humans.
This is the coffee. It's coffee. This is Eastern Africa, I think, or Egypt or something. This is funny.
You don't like it? I'm all jittery and feel like I got a big job coming.
That's funny. That's funny. Here we go. The Constitution.
Your king! Gentlemen, have you taken leave of your senses? The people shall have the right to vote. Even the stupid ones? Yes. Stupid people vote? Yes.
They all run to sign it now. This is good.
Can I be honest with you? It stinks.
This is funny.
Does your wife know what's going on? She knows a little word. You're wasting your time.
That's terrible. That's terrible.
Might as well put the dishes in the shower. Hey, Captain, what's cooking? We're putting a man on the moon. Are you out of your mind? I can't even get tuna without celery. Nobody's going to the moon, ever. Why not? It's too far. It's far. It's really far.
This is Houston or Cape Canaveral. The tense Japanese business meeting.
Like I was saying, it's FTX.
FTX.
It's a safe and easy way to get into crypto.
FTX.
Yeah, I don't think so. And I'm never wrong about this stuff.
Never. That's it. Don't be like Larry David. That was funny. That was.
Hey, I left my cane in there. What? What do you mean? Hey, that's an expensive cane.
That's really fun. Again, even myself, I'm not a big Seinfeld guy or any of that stuff. But anyhow, FTX. Notice that, and that was a very pricey. That was a little movie. That was during the Super Bowl a couple years ago. Okay, so if FTX now, that's FTX has collapsed basically, and the kid's supposed to go to jail or be held accountable or whatever. You know, Sam Bankman something, whatever his name is. But yeah. So in other words, you know, when the value of your assets are declining, you know, to the bank, to the owners of the bank, the deposits are liabilities. Okay, so to your deposit in a bank is an asset to you, but to the bank, they owe you that money at any time, that cash at any time. And if you're backing that up with assets that if you had to sell them, you take a loss, or you couldn't sell them for what you thought you would sell them for, whatever it might be. But if there's some issue with the market value, that's what's going on. So hopefully you guys remember that commercial when we talk about Signature Bank, that you had this big fancy commercial with really one of the most fantastic entertainment people of the day, you know, probably one of the wealthiest, smartest. He's a writer and all these other kinds of things. But like I said, he was partly behind the Seinfeld television series, which was big in the 90s. When I first started teaching, everybody's watching Seinfeld and Friends and all that stuff. But I missed all that. I was busy. I was at Rutgers doing the Rutgers thing. I know it was on television. So anyway, so New York-based bank faced a crisis of confidence after the mid-sized lender, the California bank, was seized by regulators. Signature was also reeling from a bet on crypto banking that floundered. It says foundered, but floundered after the. Is it foundered? After the sector imploded. Yeah, let's look. That's important. That's important that we sort through those words. Flounder is a fish, by the way, but there's a verb. To struggle or to obtain footing. Yeah, to thrash about wildly is right. Founder is like the founder of a company. So that should be flounder. After the sector imploded and banks, that's the Wall Street Journal, folks. And the banking regulators cracked down on lenders' exposure to digital assets, failure, the third largest bank in U.S. history. And again, I have to apologize. I have the banking numbers here for Silicon Valley Bank and for Signature Bank, and let's just quickly just just run to them very quick. And then I have other notes in here. I use this at my other job, so this may not be I mean you can look at this. It's a balance sheet, profit and loss. I just have to help my guys understand some of this stuff when we work on things. But I wasn't going to go over this with you guys, but you can look at it. It's a good set of notes on you can see as the accounting equation there. Okay, it's a good set of notes. This is First Republic that's in trouble. Silvergate, which is I think shut down. Here's a Silicon Valley Bank. It has a private segment, a capital segment, a security segment. Okay, so it's got those three segments. This is the capital segment, manages funds. Yeah, so I don't know why I underlined this twice. I should have done that. Yeah, that's once. So it's got these, the private banking segment, the wealth management segment of the bank, and what these banks do. And again, one of you guys asked me that question. Actually, a student from one of my 9 o'clock. I remember her asking me. One of my students asked me about that. She goes, "Who are the customers of these banks?" And she made me track down something like this. But see, it has the assets about 200 billion. The total debt number, which that's pretty good. That's not a lot of debt compared to assets. The net debt is even better. You subtract out the cash, right? That's or liquid assets. That it brings it down to 10 even. So assets you can quickly convert over and absorb some of the debt. It's headquartered in Santa Clara. Not folks, 1983. Where were you in 1983? Most of you weren't even born. Okay, I was very young, very young, little kid that year. So yeah, and also as we're just looking at this net debt or debt to equity ratios, current ratios, MQR's most recent quarter, like TTL is trailing 12 months, or TTM is trailing 12 months. What the total debt number is, what the total asset number is, and we're not going to go through the accounting right now, but we should at some point maybe do that. Actually, go through how to compute the current ratio. That's 9%, and what that really means. Those kinds of things. Ratio analysis is very important. And here's Signature Bank. It engages in provision of commercial banking services. It operates through commercial bank and specialty finance segments. The commercial banking segment consists of commercial real estate lending, commercial industrial lending, commercial deposits gathering activities. And the specialty finance segment consists of financing and leasing products. The company was founded in 2000 and headquartered in New York by John. I don't know who John Chamberlain is and some of these other guys. It says the specialty finance segment, so that should be by itself. It operates with this thing, and this is the commercial banking part of this. Real estate lending, commercial, industrial lending. And if you look at the Federal Reserve, they really care a lot about that. Those are mainline economic activities that really impact the health of the economy. And I think one of our previous, actually, no, I gave you guys the, where is it? Oh. I sent my guys, that was the March 7th note that I sent out, I think. Folks, bear with me here. Yeah, here's some of the graphs. Yeah, here's some of these. This is I sent this the 90, and of course I got the comment, Enzo, that's 90 pages. I said, I know, but so people know how the S&P was doing, how crude oil prices were doing, effective federal funds rate, dollars to buy the euro. So it's the strength of, and again, looking at this, dollars to buy the euro. When you get these, so again, this is how many US dollars, this is spot exchange rate to buy 1 euro. Okay, if that goes down, so the euro is cheaper. Okay, looking at that. That's really what that is. So the euro is cheaper there. We had a little bit leveling there. So looking at this, it says that if it's cheaper, that means the euro is stronger, right? So if it takes less dollars to get the euro, then the euro is going to be stronger. So looking at this, right, you have a stronger euro there. You have a stronger euro. Every time you have these sort of negative slope dips here, it says in terms of US dollars, because it takes fewer dollars. okay, to buy it. Or actually, fewer dollars. Oh no, fewer dollars means that the U.S. dollar is stronger, right? Because it's less, right? You need less dollars here, right? So the dollar is stronger there, but little blips. It's stronger there, and then the reverse of that. If the euro, if the euro gets, if you need more dollars, then it's a weaker dollar, and this is a stronger euro, a stronger euro, a stronger euro, right there. Right, that's how it is. Correct. I apologize if I caused some confusion on that. Whoops. This is the treasury market the treasury market graphs in terms of the yields, what the market yields are on a 10-year treasury. And again, as you're getting a lot of these gyrations here, again, looking at this as this is increasing, capital is coming out of these because it anticipates a better fixed income product in the future. So the capital comes out, it's a cheaper price for the instrument, and there's an appearance of uh, an appreciating yield, but what does that really mean? You could do better in another instrument, because if the central bank, the U.S. central bank keeps increasing interest rates, you could get a better fixed income instrument someplace else. So there's not as much demand for a lower yielding one. That's what this means. That's the 10-year, the 2-year, the 3-month, and then I subtract some of them. But here, let's get to what I was trying to get to with you guys. Here, commercial industrial loans, deposits, commercial real estate loans, the average 30-year fixed mortgage. So those are like the last 4 graphs that I looked at. So Signature Bank was playing in this field. The Federal Reserve considers that very important for the economy and the healthy economy. So there's a specialty finance segment, financing, leasing products. Commercial banking segment consists of commercial real estate lending, commercial industrial lending, commercial deposit gathering. Yeah, commercial deposit gathering activities. In other words, we want to attract deposits and then either lend out, which should be an asset because it's supposed to generate a cash flow. But if it's not generating a cash flow, then it's not as valuable. And I'm trying to get folks overseas to understand that. Okay, it's a little, So anyhow, but that's Signature Bank. That's Signature Bank, and the analysis is all simple. So you want to judge assets. So certainly J.P. Morgan and Bank of New York Mellon have dramatically bigger assets. Those numbers are very large for some of those other banks. These are, even though it's the 16th largest, the 13th largest, or the 18th largest, but it's not they're not competing with Citigroup, that's for sure, or what do you call it, or J.P. Morgan or something, or Bank of New York or something like that, or Bank of Bank of America. So okay, Signature, third largest field in U.S. history. The bank raced to find a buyer or another solution to show up its finances before Monday, but failed to get a sale done in time. Barney Frank, right? Oh, we got to protect the consumer. And now he was on the board. Okay, he was on the board of this bank. It says Signature board member Barney Frank, former congressman who formed one half of the landmark Dodd-Frank financial law, which I really haven't completely read yet because it's very long. But the idea is it's to protect the consumer. And he protected himself, I suppose. He was on a bank that had a bank run in New York. So there you go. And he said customer concern over Signature's exposure to crypto spiraled after Silicon Valley Bank's collapse. And customers said they felt more comfortable with JP Morgan. Okay. And this was now I didn't finish reading, but I saw a research note from somebody from, I forget what from maybe Morgan Stanley, that said this is really just psychological, that the banks really aren't technically in as much trouble as the way people are behaving right now in terms of maybe saying, hey, I'm losing confidence in the banking system. It may not be justified from a financial data or financial accounting point of view. So that's also something to keep in mind. Here, markets, financial. Yeah. So Frank was in there and I'm sure self-dealing. He said customer concerns over Signature's exposure to crypto spiraled after Silicon Valley Bank's collapse. Okay, we said that. It says signature customers will get all their deposits back, including money above the $250,000 limit for the Federal Deposit Insurance Company, banking regulators said. And a joint move by the U.S. Central Bank and Treasury took the extraordinary step of designating these banks as systemic risks, which, in other words, which means the financial system couldn't survive if these banks didn't exist. That's about what that means to the financial system. And, well, I think you had a very wealthy group of donors to the current party in power in the White House, I think is what really happened here. And they got this favorable classification that was that unfortunately smells of being arbitrary by the regulators, and they got their money back. So, and you can fill in the blank to the stuff I may not have said just now, but it says a systemic risk, and we should go through those the specific definitions of that. I don't have the systemic risk definition here, but I have a couple other notes that I've worked on. So this was the 14th. This was this one. Yeah, here it is. Ken Griffin. Yeah, what is systemic banking definition? So this was about 30 pages. Okay. So it's possibility to event at the company level could trigger severe instability or collapse in the entire industry economy. Systemic risk was a major contributor to the financial crisis in 2008 and considered to be a systemic risk is banks are called too big to fail. These institutions, large relative to their respective industries, or make up a significant part of the overall economy. A company highly interconnected with others is also a source of systemic risk. Should not be confused with systematic risk, which relates to the entire to the financial system. Again, like I said, but we're not necessarily, wasn't going to go over necessarily. We can go over this in another video or another discussion, some examples of this. But basically, really the definition of too big to fail, which is very important to the overall functioning of an economy. And, we need this company to survive. Now, some of the car companies, what is it, Ford and Chrysler, they received bailouts in the later 2000s. That was just sort of national pride, almost like Credit Suisse. Now, I think what happened in Switzerland is the regulators got in there and told the competitor, United Bank of Switzerland, you're buying Credit Suisse, and we'll help you with liquidity issues, lawsuits, write-downs. They provided this, so knowing what the bumpy parts of that deal would be, just to save face and not have it be owned by maybe a group that might be unappealing to the conservative Swiss or something like that. Already there was very large holders or very large equity investors in the bank from overseas and maybe parts of the world that aren't so Swiss and maybe aren't so conservative, or maybe just don't have the similar values, perhaps. So I'll let you guys fill that in. So took the extra of designating these as systemic risk to the financial system, giving regulators flexibility to backstop uninsured deposits. Hope that that and other moves to protect the deposits would contain full out from customers. And yeah, I've continually, whoops, I don't want to do that. I've continually tried to show you guys that picture, and I'll pull it out again for you. This is what's bad. There we go. Where is it? This thing. Yeah. Now these are right. Yeah, this anything that looks like this. Yeah, whatever this is. That's still small, that picture. This one, yeah, something like that, right? And now these are relatively younger people. This is the bank. This is a Greek bank run. That's what a bank run, and and not just fighting in line, but the message this sends that, hey, there's problems here, and you have to get your capital out, and that's not confidence in the banking system. I don't know what this is. Okay. Its signature started in 2001 and pitched itself to businesses and individuals as an alternative to big banks. It prided itself on customer service, lack of bureaucratic red tape, and once stood by a customer and hip hop producer Irv or Lorenzo, I should know who that is, but I don't, was facing money laundering charges. And then it says after the financial crisis, the lender grew rapidly and became an investor darling. In 2018, Signature hired or began specializing in crypto, and then hired customers or hired bankers that understood it, which is what you generally need to do when you have a very specialized banking organization like this was, and to reach out beyond commercial real estate, which was boring but probably profitable. Other banks were reluctant to take on crypto customers, and Signature became one of the crypto market's leading banks, because again, we're not sure of the value of digital assets. That's just to be very in one sentence. That's what the problem is. The focus and a bespoke pay, a bespoke means a specific payment system for crypto companies. The bank more than doubled its deposits, and it says 27% of the deposits were some sort of digital asset client. Okay, and the bank's exposure crypto became a problem as the year wore on. A market rout that deepened following November collapse of FTX. Okay, we spoke about that. And you saw the Larry David commercial, so hopefully you remember that from that. And it was dialing back on crypto and parting ways with some of its crypto clients. It says late last year, late in 2022, cut ties with international business of Binance, the biggest crypto exchange. And the move failed to calm investors, and spiraled deepened after the closure of last week of Silvergate and tech-focused Silicon Valley Bank. The bank failures threatened to further cut the crypto industry off from regulated banking systems. Some of the large digital asset companies were whatever, Circle, Internet, Coinbase, right, use Signature Bank. So again, folks, we're this whole idea of, we're going to have an open ledger and everybody's going to see whatever all the money everyone has in the bank, but it's all going to be encrypted, and no one's going to be comfortable with that. No one is with sort of having a bank record just be open to anybody. Folks, in the classroom that we use in the week, someone keeps changing the aspect ratio of the screen. I still can't, the tech staff or whatever it is at the school, we still can't figure out how they're changing it somehow. That scares me. But anyhow, it says the bank's failure threatens to further cut crypto industry off from the regulated U.S. banking system. So you want to still be a part of the conventional way to do business. But again, some large digital asset companies, Circle, Internet Financial, Coinbase, Payword, whatever, use Signature Bank. Okay, and some of the companies, I guess, they had their own emergency meetings and said, "What do we do? What do we do?" Right, to find alternative institutions to put the deposits in. This is Jesse Powell is not related to the U.S. central banker Jay Powell, but a founder of crypto exchange Kraken said the company may have to move to somebody to find more banking partners. Okay, and it's whatever, and it says servicing the industry for retailing, fine. And then it's Mellon came in and says they issue a dollar pegged currency, cryptocurrency, wrote on Twitter that they're settling their transactions with Bank of New York Mellon, which I know has done some research into transitioning to whatever the future is going to look like for clearing and settling, which may be different from how it looks today. And certainly you can bet your bottom dollar that the clearing and settling software and the whole technology infrastructure is probably 3 or 4 decades old. I'm sure it's not brand new, and it needs to be updated. There's no doubts about that. And you need a Bank of New York Mellon to approach that. Stablecoin broke from its $1 peg last week over concerns with the banking partner. Fine, man, on and on. Signature had fallen, the value had fallen 23% in a day, which is a lot since it went public, and we're down more than 75% for the year. So that's on its way to zero when you're seeing that kind of a decline. That Credit Suisse was down 70% in a year, and the shares plunged. And it says customers were spooked by the rapid collapse of other firms, began moving the money from the bank to other institutions. Okay. And again, what receivership is, it says the New York Department of Financial Services stepped in and placed the Signature Bank in receivership. Receivership is someone's going to be running the bank for the benefit of the government, for the benefit of the industry. I don't want to say it'd be nice for the benefit of the depositors. Yeah, but in other words, it's not to leave in a very probably tense situation, to leave the people in charge who are executing wire transfers. They don't say, okay, well, this is over. We're just going to take all the money and boom, head off to wherever, kind of thing. It's to avoid that. So there's a court appointed to assist creditors. A court appointed management is really what it is. an independent or trustee who effectively manages the aspects of the troubled company's business. For the duration of the receivership, the company's principal remains in place, but they have little or no authority over the what's going on. And there's a bridge bank. It's a signature bridge bank. So there's a new bank, I guess, created or invented to continue, even though Signature's been closed. It's a signature bridge bank, which probably is in operation, probably the same address and all that. And the FTX, the regulator named a chief executive who had experience at a similar sized bank. The bank at one time, at the end of in December, the previous had 110 billion on assets and 88 billion in deposits. By deposits, it was the 30th largest bank in the U.S. Okay, so still, yeah. And so certainly Signature, like Silicon Valley Bank, relied heavily on deposits that were too big for FDIC insurance, and those can flee. Those are highly sophisticated people who highly sophisticated people who move their money out of there in a heartbeat. That's a part of the problem there with stuff like that. Let's just see. Okay, this had 110 billion here. Okay, still most recent quarter, still 110 billion. Okay, that's what was in there. All right, so you had a little bit of some current topics that were here. You guys can find the definition of receivership and the FDIC and what these banks are and all that. Okay. A holding company is how a lot of these banks are. It's like Berkshire Hathaway, one company that holds the stock of another company. It's a business entity, usually a corporation or limited liability company, and it doesn't manufacture or sell anything or any products or services or conduct any other businesses, but it holds controlling stock in other companies. So it owns the assets, and it's a company designed to own the assets of another company. And there's legal reasons for this. It maintains oversight capabilities, and it can oversee the management decision. It's not supposed to actively participate in the day-to-day operations of a subsidiary, but how do you really enforce that? It can be called, sometimes this is called a parent company or an umbrella company. A holding company is a type of financial organization that owns a controlling interest in other companies. We're called subsidiaries. A parent corporation can control subsidiaries' policies and oversee management decisions, but doesn't run the day-to-day operations. And they're protected from losses accrued by subsidiaries. So if a subsidiary goes bankrupt, the creditors can't. Yeah, so there you go. It's legal insulation from a creditor. Okay, so it's probably written into law somewhere that if you're a holding company, you can have that. And again, it exists for the sole purpose of controlling other companies, right? They can own property, real estate, patents, trademarks, stocks, other assets. Businesses that are completely owned are called a wholly owned subsidiary, and the holding company can hire and fire managers of the company it owns, and those managers are ultimately responsible for their own operations. And there's a benefit for protection from losses. If it goes bankrupt, the holding company may experience a capital loss and decline in net worth. However, the company's creditors cannot legally pursue the holding company for remuneration. So, of course, there's a major legal insulation from creditors. And it's just written into the laws of America. That's how this works. It isolates problems in a subsidiary. There's an asset protection strategy, so the parent company might restructure itself or structure itself as a holding company while creating subsidiaries for each of its business lines. For example, one subsidiary may own parent company's corporate brand name and trademarks. Another subsidiary can own the real estate. And of course, it's an example of this. And again, the tactics limit financial and legal liability, exposure to the holding company and various subsidiaries, and may also depress a corporation's overall tax liabilities by strategically basing certain parts of the business in jurisdictions that have lower tax rates. If it's set up correctly, the debt liability of one subsidiary won't impact any of the others, and the subsidiary would declare bankruptcy would not impact. So yeah, it's the ultimate legal silo is what this is. And it says protecting individuals' personal assets, and they're technically held by the corporation and not by the person, who's consequently shielded from debt liabilities, lawsuits, and other risks. Holding companies support the subsidiaries by using their resources to lower the costs. Using a downstream guarantee, the parent company can make a pledge on a loan behalf of the subsidiary. Ultimately, this can help companies obtain lower interest rates. So there's sort of a built-in letter of credit, right? As the people I work with like to reference often. Once backed by the financial strength of the holding company, the subsidiary risk of defaulting on its debt drops considerably. Okay, you have that one. And then a Berkshire and what they hold, right? So if you ever cared about what Berkshire, Dairy Queen, Clayton Homes, Duracell, Geico, which is government employees insurance company, Fruit of the Loom is t-shirts, home furnishings. I don't know what Mormon is. Coke, Goldman Sachs, IBM, American Express. So again, systematically important everything's right that the Berkshire owns, and he's a smart guy that really, really, really put together one hell of a portfolio is what he did. Okay. Just let me re-PDF this because I made a couple changes to this. So if I resend these out to some folks. Okay. All right. Again, we had our discussion about this. We have some other notes here. Actually, while we're here, let's this we don't need. Let's at least work on the Excel part of this, and then what we can do. So this we don't need anymore because we're done talking about it. And then we can go to the the Treasury and the Fed, which is really the point of all this, which I guess will come at the end of the video today. What the difference is between the Treasury and the Federal Reserve? What's the real difference? So let's take a jump into, and this will be quick because this is the 3-month Treasury, and yeah, I mean, and this is what you have here with the Treasury. So this we don't need. We just need this one. And again, now this is very short term instruments that you can get a return on. It's an annualized return, so it may not necessarily be this number, but it's this number if projected over 12 months, what the return would be. So you're going to get the 3-month version of a 12-month return. Okay, and it says it's not seasonally adjusted. This is constant maturity. So, like I said, so you got to be aware and careful as to now. These are most likely annualized yields, so you're probably going to get a quarter of whatever this would be. But and actually, we should 3-month treasuries. Yeah, it's about 5% now, which is a lot. Okay, so yeah, they do it. They do the 360 version thing. This is actual days until maturity. So if you picked up, if you was 1,000 and you bought it for 900, all right, so it's going to be 100 over 900, right? And then if you got it 90 days, yeah. So what's stated, it's stated 4 times that so it's a quarter of that, and it says here, you're going to get the face value in 3 months, so you don't get coupon payments. You buy something for 900, you get $1,000 in 3 months. That's about what you do. What you do basically here on the chart. You like the monthly series, take the average. Yeah. So yeah, that's what the annual would be. And like I said, if you looked at exponential growth or geometric series versus just dividing by 4, it's going to be pretty close. So for this one, you're multiplying this return by 4, because if it's 90 days, what's 360 divided by 90 is 4. Okay, so thank you to whoever looked at this, and hopefully this is accurate. I think that sounds right. That sounds right. So, okay. All right, so let's pick up the 3-month. Let's get the data. So and you'll see how to do this with 3-month. They have everything. They've got everything. The St. Louis Fed has all the stuff you need to really have a sense of what's going on in the markets. There it is. Okay, and we went back a bit in 2018, January the 1st. Okay, so obviously, as the Fed increases interest rates to make these bills appealing to the public, you got to pay a higher interest rate than a year ago. So, which is what's going on here. So certainly and you're getting a better yield, and the yield now is about almost about 5%, down a little bit, but about 5%. Okay, so in other words, you're buying this for whatever it is. You're buying it for $9.50 or something like that. So now, if you want a 5% yield, can we back out those numbers? What do we do to back out those numbers? You can just do it up here. So this would be equals parenthesis 100 4 times 100%. Yeah, times 4. Yeah, so I think those numbers these are too big. So he's not buying it at that much of a discount. One. You're getting there. Yeah, you got the thing for about about 985 or so. Yeah, about 988. Right, you're paying for the $1,000 face value. You're going to pay 988 today. Okay, and that you'll get about that 4 to 5 percent yield, the returns. See the math. I just did the math from the website, right? I subtracted the face value minus the price, divided by the price, and then times. So this is the yield in 3 months, and we annualize it to 4. Now another way to do it, instead of multiplying by 4, you could take that return. You could take this return and get rid of this, and say, you could do it like this. You could say 1 plus 4th power minus 1. Oh, yeah, that's another way to do it. That's the geometric way. So that's the annualized rate for the year. You can see it's so close. That's they do it the simpler way. It's a little bit simpler way, but I spent a lot of time doing that in the past. So, but yeah, so it's always good to know. Anyhow, so we have this here. Let's download. So up to whatever, up to Friday, we have up to Friday, the dates for the past 18, 19, 20, 21, 22. Yeah, the last 5 years. We have the last 5 years. And again, the reason you have higher rates here is because the federal funds rate keeps increasing. So to make these things appealing to buyers, you got to offer more. That's really what's going on here. Okay, obviously, you had very low here. I hate to say this is what caused inflation, but you were so close to zero here with the treasuries that you couldn't offer any more. The Trump years were a little bit better, but not that much better. And folks, again, just bear with me here. We're gonna have to go through this like we did last time, and we have to clear out all these not applicable pieces here. So forgive me. I know it's a little tedious and monotonous, and I know that, and I apologize for not having a better way to do it, but yeah, I'm just gonna hit control. All right, we deleted a bunch of them just there. One more. Christmas, New Year's, whatever that is, President's Day or something, right? And like I said, I said it in the last video. There's a way to do this, I think, but still, what someone had showed me still seemed like a lot of work. So it didn't seem like it was more sophisticated. I'm doing it sort of the brute force method here, but it was better, but not that much better. It wasn't lightning fast. You still had to click on a lot of things, and you still had to do some things here. Okay, almost done. This is 21, 22. Okay. Shift, left arrow, control up. And this is just the data copy. Then you're going to come into we have observation date, and you'll do paste just the values because you're already set up, and then clear this out. You don't want a lot of fill in there. And then also, you're not going to hit it with those borders. Alt H, B, no borders. And then I think you saw what you have to do, because this was whatever. I made this a couple weeks ago. This has got to come down all the way. So you're up to like 13, about 1,300 pieces of data. And then you're going to grab these two, copy, and you're just going to paste the formatting and then hit escape. Okay. So you have all the yields. And again, I think what's best is that we sort of look at like this, right? We're going to look at just 1 month. And actually, before we start doing all these borders, let's do the basis change. All right, so just multiply this by 100. So that's a -3 basis. And then let's turn that into a percentage. See what we're doing? So the basis here, this is simply just the delta between today and yesterday. How many basis points? We're down 3, even, down 2, up 6, down 1, down 2, up 1. Whoops. Okay, so like I said, so we're going to, and here, the percentage is just this. It's that delta divided by the previous yield reading. So you can see, well, this one was, you had a 4% move in a day. But when you're low and you have a slight basis change, but still can be 4%. And you can see recently you had -6, so you had -400 plus 600 minus 300 minus 300. So you had some movement, right? You had some movement here. Okay, and we'll find the average. But like I said, what you should be doing is you should be going through this. What these bottom borders are, right? Which is right there. You know. And like I said, you can go, whatever. You should do them all, but we're not certainly going to do them all in the video here. But you should. So now what you want to do, you want to say equals, right, average. This is just the delta for the, and you can center this. That's just the basis point. So at average, a 1 basis point increase is what it did. And so that's about a fifth of a percent. And then you can go through all these places and just drop them. And then we can go back and start fixing if we need one more, one less, something like that. Okay, so this has to be what? This needed to be up a couple right there. 4 right there. And like I said, then you go through. So the average change, the average daily change was about 1.5%. That's average daily change there. 2% average daily change. There. And there. So again, this is about 1.75% average daily change. There. You can go in and type. You could change it too just by typing. The average change was about 1%. Yeah, this is 1187, not 9. Okay. Like I said, just keep going through. This is 1208. There. Now you see December had the average basis change was 0, and the daily percentage change was 0.06%, which is low volatility, very low volatility. January also for the 3-month was again low right there, 0.2. And let's see recently what we're going to be looking at here. Oops. Up to March, whatever that is, up to March 23 here. Yeah, still not that volatile. Yeah, the average change was, whatever, a -0.5% decline. Because again, capital left and went into other, or anticipating a better instrument that would be out. Okay, you save that, so there you go. So now again, the Treasury bill, you pay for it, then you get the face value. So if you're paying, who would pay over face value? You wouldn't. If the market is $1,010, you're getting $1,000. You're losing. Why would anybody do something like that, right? That'd be crazy. And then what do we do here? And we could graph volatility. This is market yield onto your constant Treasury, whatever it is. So this is copying this thing. You want to click, and now what you want to do is you want to be BV and BW, right? This is BV. BW. Okay. Yeah, that's the graph that we just saw on the website. It's no longer 2-year. This is 3-month. Yeah, it's not letting me change. That's fine. Do like that. Oops. Oh, we can move it, but we can't. It doesn't seem. It doesn't seem like I'm able to, for whatever reason, I'm not able to expand it. And also, you want to right click, select the data, and edit. And this is 3. Oh, there you go. All right. So you have another one of these. You're just stacking them up right over here. So what do you have? You have the index, 10-year, 2-year. Okay. Going back 5 years or whatever that is. All right, so you'd have another one. So like I said, I'm just methodically showing you guys how to look at everything. Okay, you have the market yield here. You have the S&P 500. And you could even do volatility if you want. I think somewhere we did the daily. Yeah, actually, with this is the daily price change, the index, and we could do this is like a volatility graph. We could do a similar one for the yields on the debt instruments. We could do that's not that. All you're doing here, as you guys recall from the first video, you're just graphing the percentage change. That's all you're doing. Okay. And again, you saw how we reused the graph. All I did was I changed the columns. So after you go through the steps of making the yield graph for the S&P, so if you have another index, instead of recreating that graph from scratch, you could just sort of reuse what you already have. All right, we're not done. We're not done. Okay, we're not done. So then the last part of what I want to talk about today is the difference between the Treasury and the central bank. All right, they're separate entities. The Treasury manages the money coming into the government and paid out by it. The Federal Reserve's primary responsibility is to keep the economy stable by managing the supply of money. So the Federal Reserve sets I think one of the videos I may have said the Federal Reserve prints the money. The Federal Reserve orders money printed from the Treasury. That's really who prints them. It says the Treasury manages federal spending, it collects government tax revenue, distributes its budget, issues its bonds, bills, notes, prints money. Okay, it issues the instruments. So it's headed by a cabinet level appointee who advises the president on monetary and economic policy. Okay. And literally prints it. I like that. Okay. The Federal Reserve is a central bank. It's run by a board of governors that oversees 12 regional banks. The primary goal is to regulate the nation's private banks and manage the overall money supply to keep the inflation rate and employment rate stable. Okay, this is what it's trying to do. And you'll get various, and it should be open to criticism. If we live in a country where we can't criticize anymore, we're in a lot of trouble. And I'll tell you, it just, in a scary way, it just feels like we're sliding to that where just don't criticize kind of a thing, or else, right? It really feels like we're headed there. The Treasury is known for printing money literally and offering economic advice. Fine. The current Treasury is run by a federal central bank, the head central banker, Yellen. The Federal Reserve is the U.S. central bank, ensures lenders and borrowers have access to credit and loans. And the two work together to provide a stable U.S. economy and borrow money when the government needs to raise cash, that kind of a thing. They're instrumental in fighting recessions and bailing out other institutions when necessary. The Treasury is the older. It was established in 1789. Alexander Hamilton, and there's a statue of him down in Lower Manhattan, the corner Wall Street and Broad, I think it is. Or is it Washington? Yeah, but that's where Hamilton was first secretary, but he also did something else down there. I have to look. I have a picture. The students from last year, we had a picture in front of whoever that was. It's either Washington or Hamilton. I apologize. I should know what statute down. I apologize for not knowing that. But yeah, it advises the president on domestic and international economic issues and implements administration's economic policies. It's best known for its role in collecting taxes and managing governmental revenue. The official mission is to serve the American people and strengthen national security by managing the government's finances, effectively promoting economic growth, stability, ensuring the safety, soundness, and security of the U.S. and international financial systems. Okay. And you have these notes, and this is the estimated amount paid by the Federal Reserve to the Treasury. 19, 20, I looked up the other number. Obviously, it doubled since. Okay, so they're picking up receipts, is what they're doing, paid by the Reserve to the Treasury. And we'll go through where those receipts just came from. And it says the Federal requires the Federal Reserve to remit excess earnings to the Treasury after providing for operating. So after the Federal Reserve banks operate them, pay dividends on whatever they need to pay dividend on, any amount necessary to maintain surplus. And then during a period when the earnings is not sufficient to provide the cost, a deferred asset is recorded, and the deferred asset is the amount net earnings the reserve banks will need to realize before their remittance to the U.S. Treasury can resume. So, yeah. In other words, whatever, you're the Dallas Fed and you're doing really well, and you operated your bank, paid dividends, and then whatever extra you needed to hang on to, then you have a deferred asset. All right, and it says the earnings of the and then it says obviously that amount is sent to the remit, means to send. The regional central banks send it to the Treasury, and the Treasury records, well, the Dallas Bank sent us this, the Cleveland Bank sent us that. It says the deferred asset is the amount of net earnings the reserve banks will need to realize before the remittances to the Treasury can resume. What does that mean? It says that the deferred assets, amount of net earnings the reserve banks will need to realize. Well, it says what they need to realize: cost, payment of dividends, and then whatever regulatory ratios. It says maintain a surplus, so that's a regulatory ratio. Okay, and then the extras, the deferred asset that's held at the Treasury is what this said. That says the deferred asset is the amount of net earnings the reserve banks will need to realize before their remittances to the Treasury can resume. I know what they're trying to say, but I think they word saladed it a bit on us here. It says to accomplish the mission, the department provides economic advice to the president, works with other federal institutions, and encourages global economic growth, raises standard of living, all that. So internal revenue services under the Treasury. The Mint, the prints bills and mints its coins under the Treasury. And the Treasury is really a treasury too. It stores most of the gold in a vault in New York and the Fed. And one example of how the responsibility of the Treasury and Fed overlap. All right. The central bank was created in 1913. To growing concerns that the financial system will be dominated by and manipulated by a small number of banking institutions for the benefit of a few business titans of the day. Its most visible role is in adjusting the interest rates paid for U.S. Treasuries. And we just graphed the 3-month just now. And this is U.S. Treasuries. Another debt issued by the Treasury, and this is other debt. Okay. The change the Fed decreases directly influences all other lending rates. Or decries. Decries means states, right? Certainly, businesses, consumers. Again, what you're paying for that 3-month Treasury that we just graphed a couple minutes ago, that depends on the interest rate that's being offered. So, you're paying a lower amount, or the market will let you pay a lower amount if that rate is bigger. Right? That's sort of the result of, okay, that's the instrument that's in the market right now. That's the best 3-month yield that you're going to get, and this is what we think it's set by the market. It's set by bids. It's set by the market. Is somebody in the basement in Washington or New York or something says, here's what it should be. But certainly, by setting interest rates, you're controlling eventually what that price is going to be. And you're keeping the right balance between inflation, unemployment in check, and you don't want the economy to be too active, not too active. So it's we're living in quite a time right now. We had 2 decades of pretty much very stable inflation, or very almost you never heard inflation for about 20 years. Now all of a sudden that's all everyone's talking about. But lenders and borrowers have to have sufficient access to money and credit. And I think right now with Obama, when Obama came in, I think the ideas were just keep printing money, and that we'll see what happens. The Federal Reserve regulates or supervises and regulates banks in the U.S. No one owns the Fed. No one profits from it. It's a not-for-profit entity. Okay, but it's a service to the American financial institutions on behalf of the United States government is really what that is. Some of the differences, they work together. That's for a stable economy. The Reserve acts as the government's banker, processing transactions, including accepting electronic payments from Social Security taxes, issuing payroll checks to government employees, and clears checks for tax. So who does the clearing, and who processes the transactions, and who prints the money? And it's just broken up into a couple and these 2 separate entities here. They work together to borrow when the government needs to raise capital. The Federal Reserve conducts Treasury security auctions on behalf of the Department of Treasury. Example. So, the central bank conducts the auctions on behalf of the Treasury. Okay, and these are some of the bonds, bills, notes. Right, they get longer as you go. Actually, the notes are bonds are the longer, notes are the 10-year, and the bills are the shorter term. They're linked in another way. They're both nonprofits, and after the expenses are paid, any remaining profits are paid to the Treasury. The Treasury uses the government to fund government spending. Its relationship produces a considerable amount of money. The Federal Reserve contributed an estimated $55 billion in 19, and then some of the other numbers were here. We had them up here someplace. Yeah. And if you guys don't mind, as I just sort of clean this up a bit. And this is 2021. 88 billion. And 107. Again, I think the fun of using the notes that we use is we have to update everything ourselves. I remember looking that up someplace. Okay. So you have that one. And again, you guys have all these notes. These dual agencies want to fight recessions and bail out companies and all that. Okay, so those are some of the dual things that are happening there. And we've had plenty of conversations about this. Again, uh, obviously to trying to stop a recession, you're going to reduce interest rates. We're increasing interest rates, obviously, and it says making more money available to the banks. But again, we're supposed to be tightening now, or taking money off the commercial banks' books, giving them back their securities, and basically the central bank is going to zero out these securities and say, look, now they're worth nothing as opposed to whatever they were worth. When the Sussex County Bank or whatever it was, sold a security to the central bank, and the central bank bought it and put the money in the central bank's accounts. Right? That's quantitative easing is making capital available to lend, and we're doing the sort of the reverse of that right now. Or we're making interest rates appealing, but we're making interest rates appealing, but we're going to be altering the supply. So we're sort of doing one thing to sort of cool it down, and then if we're going to expand quantitative easing as opposed to reducing the central bank's balance sheets, we're going in the opposite direction. We're trying to cool down the economy by raising interest rates, and then you're going to stimulate economic activity by having more capital available to the commercial banks, but at a higher rate. But that's where we are. So tax rebates, spending, right? The Treasury sends you your tax rebate generally, right? Um, these lending companies, Fannie Mae and Freddie Mac, the central bank and the Treasury operate together on that. When they run into financial trouble, the central bank can provide access to funds at a discounted borrowing rate, while the Department of Treasury can increase the line of credit that makes available to the entities and even purchase their shares. And then this is the 08. We have a video on the whole 08 crisis, so I'm not going to rehash that right now. Chrysler, the savings and loan industry in the 80s, the airlines. Okay, we've had lots of government-sponsored bailouts of non-governmental corporations because there's just there was a big account there to sort of help when the country needs help. It's there to help. That's pretty much that. Okay, sorry folks. So we did a lot today. We did the 3-month bill. We talked about Signature Bank, the difference between the Treasury and the U.S. Central Bank, and a little bit on holding companies. Okay, so you had a lot of that. And actually, let me get the holding company notes, and we'll call it a day. Oh, all right. So I just put all the notes in for the link to YouTube, so we're all set with that. Okay, we have that all set to go. All right, this we cleaned this up. That's okay. We did our 3 graphs. What's the difference? We worked on this. And then, so this we did, the Treasury, we talked about the Treasury. We could see if we'll fit in some of these other, the federal funds rate, that could be the next one, and the difference in treasuries and all that. So those could be next. All right. All right, folks. Thank you very much. We'll see you next time.